The Shadow of Truth. And today is Monday, March the 7th, 2016. And your hosts are Dave Kranzler from InvestmentResearchDynamics.com and Rory Hall from thedailycoin.org. And we are very honored and have the great pleasure of welcoming back to the show Mr. Craig Hemke, who is the proprietor of TFMetalsReport.com. And Craig, how you doing today?
Oh, Rory, just fine. And hello to you, Dave.
Hey, Craig. How are you doing? Sounds like you're doing well.
Yeah, it certainly is a crazy, fun time, no doubt about it. And interest in the metals is returning. Business at TF Metals Report has never been better. And it almost feels like maybe we finally made it through the storm.
Making it through the storm. That's a good thing. Dave, I didn't say hello to you, so hello, Dave.
Oh, hi, Rory.
I hope you're doing well out there in Denver.
You know what? It's almost like summer started here, so I can't complain.
Well, it sounds like we have some good news coming from Craig, so let's. You want to start us off there, Dave, and let's see what he's got to say?
Well, one thing I wanted to chat about, Craig, is a couple of weeks ago, I think everyone who watches the markets were expecting a massive sell-off or pullback, whether it was natural or naturally occurring or manipulated, which is normally what the case is. We were all looking for a big sell-off in this sector, especially, as we went through the COMEX options expiry period, and yet the metals keep going higher. And what do you make of all this?
Well, it's not as if it's been easy. The banks are playing their old song and dance that they do all the time. I mean, nothing has changed in that regard. There's been a lot of talk out there about, is this it? Is the COMEX finally failing and all that kind of stuff? And we're nowhere near that point. At least it doesn't appear to be as yet. The banks are just simply issuing as much paper as they need to issue, or at least as they feel they need to issue to contain the rallies. The latest open interest figures that we've seen come in from Friday. Remember Friday we had all this volatility and gold all the way broke out through 1263, got all the way to 1280 or something like that. And it looks like the banks created another 15,000 contracts or so. Open interest now on the gold COMEX is nearly 500,000 contracts, up from 380 4 or 5 weeks ago. So that's a lot of paper gold that they've alchemized out of the blue. I mean, it's not like, the banks have dug up some gold and put it on deposit at the COMEX and then levered it a couple of times. They just simply create new paper to meet the speculator demand. If they hadn't, if that amount of paper was fixed, I mean, gold would be considerably higher than it is now, no question about it. So they're playing the same game they always have. What set off the warning signals back in mid-February was a recognition of that these net positions of these banks is reaching extremes from which raids have begun over the last couple of years. Now, does that mean that a raid is imminent? Not necessarily. It's just a warning sign more than anything else. As you note, David, prices have kept going up. And I think the main reason for that is the severity and the duration of this rally, because we've been chugging along really since New Year's Eve. I've been plotting on my site for folks a trend line that goes all the way back to New Year's Eve. And it's a beautiful thing, man. I mean, gold has just tracked it perfectly for 10 weeks. It's pretty slick. And you can use that trend line to form a pennant or a flag off this latest consolidation. And now we have a breakout. So technically it looks really good. The duration of this up move, though, is what's, I think, providing the support. And what I mean by that is because we've moved up now for 10 weeks and moved up so sharply, the 50-day moving average in gold has turned up, and it is bullishly crossed through the 100-day. It is also bullishly crossed through the 200-day. And I haven't looked, but I think the 100-day is about to cross through the 200-day. Just that technical setup, and then the recognition of this, this resolution of this latest pennant, I think is bringing new speculative money into the COMEX paper market. That's why the banks have to create so much extra paper. But it's that I guess it's almost like a I don't want to apply like there's some kind of artificial intelligence to these computers, or that there actually is human beings somewhere that are making these decisions. But it's almost as if the high frequency trading computers have a big switch that have been flipped from sell every rally, because all of the the momentum was down and the moving averages were going down, to now that switch has been flipped to buy every dip because the technical picture is so good, and that seems to be underpinning the paper market, regardless of all of this bank short selling. So I don't know. It'll likely continue and hang in there at least until we get to next Wednesday, which will bring the conclusion of the March FOMC meeting. And man, all bets are off at 2:00 on Wednesday the 16th.
As per usual.
Yeah, exactly. I am, back in October, actually, let's dial it back even further. All through 2015, there were these talks, oh, the Fed's going to hike rates. Oh, the Fed's going to hike rates. The market was capped on a January rally last year and then driven all the way lower to St. Patrick's Day, March the 17th, when at the conclusion of the March FOMC, there was no rate hike. And all of a sudden, prices rallied into May. We got summer, and we got September, and everybody was convinced, okay, here comes the rate hike. And then there was no rate hike, and we rallied all the way into the FOMC of October. And it was then that we were capped and rated and driven down all the way in December. That's where now, if you're looking for any singular event or news item that could cause a massive raid to get these banks to really send the specs to the exits all at once, it'll be the FOMC of next Wednesday, the 16th.
Okay. Well, I mean, I agree with you. What I find interesting about this move, and this has occurred, it occurred in 2005, 2006, and then it occurred in late 2008 when the Huey ran from 150 to 300 in 2 months. Well, actually, this didn't occur. The stock market would continue to go down, but typically when there's periods where gold and the stock market move up together, or gold and the dollar move up together, it's usually followed by a big sell-off in the stock market, a big sell-off in the dollar, and the precious metal sector continues to move higher. And so right now, the precious metal sector is correlated in the same direction as the stock market, and I find that to be interesting. So, I mean, if your scenario plays out, if the Fed raises rates, which I don't think they will, we should get a sell-off in everything.
It depends, Dave. Excuse me. I remember you and I talking about this back in January, and you actually came up with, I think, the right theory in that the relationship between the Chinese yuan and the yen, and that as the Chinese devalue the yuan, it unwinds a carry trade and forces the yen higher. The yen higher on the inverse is the dollar yen going down, and the dollar yen going down drags the stock market down. And so it creates kind of as you look at those set of relationships, it creates an interesting, almost a dichotomy with the past, because I think the average way to look at the market is that a delay in any rate hike, something that where the Fed says more liquidity, should be good for the stock market, and it might. But if they weaken the dollar, that makes the yen get stronger, and a stronger yen is what causes the computers to sell stocks. So that's why they almost rally the stock market by jawboning and talking up the dollar. It's, again, if anything, it's a great example of how perverted these markets now are, because they're so completely dominated by the HFT computers. We'll see. Again, referring back to our conversation in January, Dave, the Fed's really in a box, because if they do jawbone, or even, God forbid, pretend like they're raising rates again next month, that's going to rally the dollar. And if they rally the dollar, then that's going to drag the pegged yuan with it. And we're going to be right back to where we were at the end of December, early January. The PBOC starts devaluing the yuan, and markets start to crash worldwide and all that stuff again. So it's going to be very interesting to see what happens next week. Again, I think they're painted into a corner, and they'll probably choose to do nothing, which should ultimately be beneficial for gold. But Again,
See, I think
it's impossible to predict.
I think that's what the metals in the stock market have been pricing in. I think they're pricing in a non-event meeting.
Yeah, and you're right, Dave, to point out. I mean, it is everything outside of the bank picture. And again, this data that I refer to when I talk about the bank picture, that whether it's the commitment of traders report or the bank participation report, it's all dubious crap anyway, because it's generated by the criminals at the CFTC.
I agree.
You know, so I mean, you can put we put some stock in it from just a historical perspective, in that I've been keeping track of this stuff for years, and so I can actually look back and say, okay, the last time the cot positioning was this, then this is what happened next. But other than that, to sit here and say, oh yes, this data is this is pure as the driven snow because these regulators, they're honest and fair. It's all garbage. I mean, the CFTC is criminal co-conspiracy. Hell, it was just 2 weeks ago that they convened a panel again of 9 people to vote on whether the CFTC should enforce the position limits that are mandated by law, the Dodd-Frank law. And the CFTC just said, screw it. No, we're not going to do that. What? Hold on a second. This was a law passed by Congress, signed by Obama. The CFTC should have to enforce these position limits. But they convene this panel. The panel gets lobbied by the lobbyists from JP Morgan and the CME Group, and then they vote 8-1 to not enforce the position limits. I mean, what else proves to you that this is a totally captured regulatory agency? So when they crank out these reports, we're supposed to take them seriously in the first place. And then the reportees, the people, the entities that are giving the data to the CFTC, we're going to trust JP Morgan? And then furthermore, as if the only positions they have are the ones that are listed as banks. They've billions of dollars in offshore accounts that show up as hedge funds that aren't counted amongst the commercial category. So anyway, we can sit there and look at these reports and make conclusions and say we need to be cautious. But really, getting, I guess, to my original point to what you said, Dave, everything else looks really, astoundingly good. The supply-demand fundamentals are breathtakingly strong. The amount of gold that's allegedly flowing in all these ETFs is at record levels. The mining shares have moved up 80% in 6 weeks. There's all kinds of things to be excited about. So hopefully these trends will just continue, and these COT signals, these commitment of trader signals, are just simply warning signals that don't necessarily add up to an imminent price decline.
It's funny because I've been writing about this point for a long time, about the commitment of traders and the CFTC and the reports that come from the COMEX. And it's funny because there's a few guys out there who make a good living off of analyzing the COT reports. And my point on that is, well, wait a minute. How do we know these numbers are real? JP Morgan's already been fined by the CFTC for rigging.
Yeah.
I think it was the gold or the silver COT report. They were stuffing trades into the hedge fund category that should have been going in the bank category.
Yeah.
And it's like, the data for these reports come from JP Morgan, HSBC, and Scotia. And if they report these numbers honestly, it's the only part of their business that they do report honestly. And what's the odds of that?
Yeah. And then the CFTC sits on it for 3 days. They get the information at 1:30 on Tuesday. They can have the report by 2:00. But instead they sit on it for 74 hours just so that it's utterly useless. Like last week.
Japan publishes their equivalent every day. Why can't we?
Yeah. Again, we're talking about a criminal co-conspirator in this process. There's no doubt in my mind that the CFTC should be classified that way. And we could go on and on about that. But the moral of the story is that there are fundamental reasons to be excited that gold has finally turned, and it continues to break higher even from a paper standpoint. And I think we should all be excited about what the rest of this year holds, because really what we're talking about in these paper derivative markets is basically a confidence scheme, which is a polite way of saying a con game. That's where the shortened term con comes from confidence. It's a confidence game. It's a confidence scheme. And they're basically living on kind of let's call it a just-in-time delivery process, kind of like your grocery store, right? The whole supply chain in this country for everything exists on a just-in-time delivery process, right? And you don't go clean out the shelves at your grocery store of all the bread and the milk because you've got a pretty good confidence that if you need to go tomorrow, they'll have it tomorrow. And as long as that just-in-time scheme keeps working and you have confidence that it's going to work, and you don't feel like you got to go clean out the grocery store. But as soon as there's a delivery failure, as soon as one entity shows up, be it an ETF or a pension fund or a hedge fund, somebody requests gold out of an ETF, out of the LBMA, out of the COMEX, whatever, and they don't get it, the entire confidence scheme starts to crumble. You get a run on the bank or, in the grocery store in this example, and all of a sudden everybody wants their gold at once, and that's when the whole thing crumbles. All of this demand and this rising price leading to increased better sentiment and even more demand is fracturing and really, really stressing this fractional reserve confidence scheme. And then that's where, again, hopefully things will continue to get even more exciting as we go through this year.
But why didn't we see something along those lines on January 28th when there was a complete and utter failure in the pricing of silver, when there was an 80-cent breakout or an 80-cent difference between the futures and the spot price? People didn't go running out and say, to hell with you guys. That didn't happen. Nobody said anything. I mean, there were the understanding that I have is that a few of the members did resign right after that, but nobody's done anything. There's been nothing at all to happen. And as you just described a minute ago, we are living in a world without the rule of law, period. I mean, and that's what you and Dave have just described and that's our entire system. It doesn't just apply to, this conversation or the stock market or the precious metals market. It applies across the board to everything. We are without the rule of law, period. But I wanted to ask you, Craig, you and I had spoken at the end of January about the death candle, and I wanted to follow up with that. I'm gonna keep hammering away on that. I'm gonna keep it in front of everybody, and the purpose of that was to get an update on this daunting movement in the S&P, and I was looking at a chart over at Investing Haven, run by my friend Taki, and the current movement in the S&P is almost identical to the movement in 2008. I was asking you then, I'm asking you now, will the PPT or the high frequency traders be able to stop a collapse, or will actual human beings of the institutional money, the hedge funds, so forth, will they be able to overwhelm the market?
Dude, I have no idea. What are you asking me that for? I just thought I knew I'd get a laugh out of you on that. I haven't, but honestly, I don't have any idea. And every time I've written a report, and I've written now 6 or 7 since early August, when this all became apparent that the stock market was rolling over, every single one has come with that caveat that though there was some central bank intervention in 2001 and again in 2008, it is nothing, or it was nothing like what we have today. I have written, I don't know how many articles, and we mentioned it early in this call about the dominance of HFT, high frequency trading these days. And it's been documented. It's now 85% of the volume on the New York Stock Exchange. So if you want to manipulate the market, people say, oh, the stock market's not manipulated. It would take, $10 trillion to manipulate the stock market. No, it wouldn't. All you got to do to manipulate the stock market is manipulate the computers. And so if you can get the computers to do what you want them to do by affecting the inputs that these computers key off of. And the primary input as to whether the computers buy or sell S&P futures is the dollar yen. We've written about it countless times. I've posted 10,000 charts showing the day-to-day one-to-one correlation of the S&P futures tracking the dollar yen, the USD JPY. So if you want to make the stock market go up, or if you want to make it reverse from a critical support level like it was at a couple of weeks ago when it was seemingly starting to make new lows at 1810, you want to make it do what you want it to do, hey, you just have your friends at the Bank of Japan or some other central bank move that dollar yen, and then the computers will follow. It's complicated. That's all that it is. So, caveat. I'm sorry, you're right. I didn't mean to interrupt you, but that's the main caveat before we go further.
Well, I mean, so
what does that mean?
Crashes of the past are done with. Is that what you're saying? I mean,
well, no, I wouldn't say that. I mean, I still think, as your friend pointed out, the action in the S&P is so eerily similar to what we saw in 2001 and 2008 that you're just whistling past the graveyard if you're 100% invested in stocks in your 401k or something and thinking everything's all fine and dandy like CNBC tells you. Yeah. I mean, when I first pointed this out in August of last year, said this looks like it's rolling over, and we called it the death candle for the S&P. And as that played out, it played out almost exactly as the rollover death candles of December 2000 and 2008, both from a monthly range and from a total change for the month. So then we said, okay, if we're going to start tracing out similar patterns and breakdowns, we should next get a rally, because that's what happened in early January 2001 and in the spring of 2008. And the rally that took place last year was almost identical again in range and percentage change. And we said, okay, now the next thing that should happen is the market should begin to roll over now that that's completed. And obviously that's what happened in January. On the 1st of December last year, I said, okay, from looking at this from all these different angles, trying to find what could be the last piece of the puzzle, I decided that if you look back in the past, the key that was like the final nail in the coffin for the bear market of 2001 and the bear market of 2008 was when the 6-month moving average of the S&P bearishly crossed downward and through the 24-month moving average. Once that happened, the bottom dropped out. And I said, we'll just wait to see if that happens again. Well, at the end of February, it happened. And the 6-month has now officially bearishly crossed back down through. So that means, if we're going to continue to follow what happened in 2001 and 2008, what came next was about a 40%, 45% drop in the S&P over the next few months. Now, can that be averted? Sure. The Bank of Japan can institute all kinds of policies to weaken the yen, drive the dollar yen higher, and make the S&P go up with it because the computers are in charge. But if history continues to repeat, then it won't. And so, again, if anything, it's just a warning for anybody that, remember the old saw back in 2008 that your 401k became a 201k? Mm-hmm. Anybody that's listening to us that has, I don't even care. If you don't own gold, whatever, that's fine. But you probably own stocks, mutual funds. You probably got mutual funds in your 401k and all that stuff. And you've benefited from the last 5 or 6 years of this banker-driven rally. Man, now is not the time to just be sitting there thinking that it's just fine. Everything's just going to keep going higher. Now is the time to be pretty cautious given what we've seen in the past. And so that's your update. All the pieces have come together, and now we'll just have to see if history continues to repeat.
Well, that's when I looked at this chart this morning, it was just like, oh my God. You could almost overlay them, and there would be so little difference in the two. It was terrifying.
Yeah.
It really was.
I just wrote a summary again a week ago, Rory. I'll send you the link, and you can include it with your text on this podcast if you want. People can read all about it. It's got all of the data from the past 6 months and how it compares with the other market tops and all of the charts. So that might be helpful for anybody that's been listening to this.
Yeah, like I said, when I was looking at that, it was this morning. It was just like, oh my God, I gotta definitely have to bring this to the table. The next thing I want to ask is about crude and the interview you did over the weekend with Crush the Street. you had talked about crude being lined up with or influencing the gold market, I believe. And
Well, we talked about it in terms of the stock market.
okay,
Not so much the gold market. It's copper that has been rallying, and that's helping the paper silver market. But anyway, go ahead.
well, I was going to ask about what I wanted to ask you about is that there's some people that are calling for a bottom in the crude oil in West Texas and Brent both. And it looks like there's resistance somewhere 42 to 45 range on both of those charts. And will that, excuse me, if that breaks out above that, wouldn't that be positive for gold and silver, or would there be any effect on it at all?
It would be positive from just kind of a background, secondary or tertiary concern. In that, if crude goes now on a kind of a sustained rally, it'll probably drag along copper, like we talked about earlier, and all of the commodities, because there'll be this kind of perception that this overall commodity bear market's finally over, and that will help. But again, on a bigger picture, I just can't emphasize enough the importance of the high frequency trading and the cues that these computers take from these currency pairs. The biggest driver of this bear market in commodities has been the weakening yen since 2012, when even though the U.S. was doing its QE all through 2013, I mean, what did the Japs try to do? Like double their money supply? And they're printing yen to buy ETFs. I mean, it's just perverse what they've been doing. And the yen has been, in relative to the dollar, almost cut in half from 2012 into some mid part of last year. What got my interest and what made me feel even more optimistic about this year, because on my site in December, there are a lot of folks out there that were saying, "Oh boy, gold's going to 800 in 2016," and I was not in that camp. I was telling everybody to expect a rally in January and February, and it's played out. And one of the reasons for that was a couple of forecasts that I saw from some of these big banks in December calling for a rally in the yen in 2016. And that has played out. That is what's been happening, and that's what's helped gold and silver, obviously. But I think in general, if the yen continues to rally and strengthen versus a dollar, that will help all commodities, including copper and crude and everything else. And so, anyway, the long answer to your question, Rory, it appears as if in the background, all commodities in general are rallying and turning higher. And that will provide kind of a favorable environment for paper gold and paper silver to maintain their rallies.
The charts kind of are what they are, but Rory and I were kind of talking about this before you had jumped on today, Craig, and that is, I think that the correlations between, say, gold and oil and the S&P, et cetera, I think they're all just indicative of something that's going on beneath the surface. And you were touching on it earlier, and that is there's central bank intervention going on in these markets. And they're not overtly printing money right now, although they've been threatening to do it for especially the ECB and the Bank of Japan. But I think that they're using derivatives and the credit mechanisms to make sure that the stock markets do not go lower and that oil doesn't go lower. I mean, if oil keeps going lower, it's going to blow up these bank balance sheets, and they're trying to prevent that from happening. So I think what we're seeing beneath the surface is a massive Fed intervention. And whoever said, the Fed needs $10 trillion to manipulate the stock market is an idiot. They do it by, they put in a huge bid. And we've known about this. I know people who have traded on in the S&P pits in Chicago, and everyone knows what the trading number is for the Fed. And they put a huge bid in for S&P E-minis. And now, back then it wasn't as effective, because now, as you pointed out, the HFT algos, the HFT-driven algos, see that bid and they front run it. And the Fed doesn't even really need to put a lot of money to work. They just need to show a huge bid, and boom, it's off to the races with the algos. And that's what we're seeing. And it's one of these things I don't think is going to last forever. And I think at some point, these same systems that they're manipulating, as you pointed out and described, I think they're going to turn on the Fed. And I don't think anyone can. There's no way of predicting when.
And Dave, to that point, the same thing. It's happening today in gold. The term that often gets used is spoofing. That these imaginary bids or offers show up, these huge numbers, and it has the effect of kind of sitting on the market. That Eric Hunter Nannex tends to document this stuff pretty well. And we've seen, I assure you, that's what's happening today. If you've been watching gold on intraday today, it's been sat upon. It should be probably $10, $12 higher than the $12.62 that it is at present, based off of how the dollar yen has moved since Friday, but it's not, and it's been flatlined and just does not allow it to catch any movement higher. And that's no doubt some HFT spoofing of showing of just huge offers that essentially scare off any potential bid movement. And it happens again on an almost daily basis across all markets, like you said. No doubt about it. Can we, one other thing, Rory, if we get it, could we address one other thing? I don't know how much time we have remaining, but I would imagine this is a subject near and dear to Dave's heart too, and that's this war on eliminating cash.
Jump in.
We started seeing, anybody that follows the headlines or follows the financial news, you started seeing these stories last year. I think I remember even seeing a story like on the cover of Time magazine. There's like, what do we even need paper currency for anyway? I mean, you could pay for things with your phone. And they phrased it to begin with in these trial balloons as from a convenience standpoint. Well, now as the trial balloons seem to get floated on almost a daily basis, I don't know if they were just planting that seed, get that buried in the back of your mind. Now it's all, what do we need big bills for? Because they're only used by drug dealers and bookies and the like for all their nefarious activities. And there's clearly a movement afoot to kind of slowly, almost subliminally educate and warm the masses to the idea that they don't need hard currency anymore. And there's no doubt that is a precursor for the institution of negative interest rates here in the U.S., in the EU, where once the banks eliminate cash so you can't hoard it and delever the system by taking cash out, then they can charge any negative rate they want, make you pay the bank in almost a confiscatory scheme to prop up and in a sense bail in the banks. There's no doubt in my mind this is coming. And when you talk about fundamental factors for owning gold and silver, physical gold and silver, well, that's as good as it gets. Now, I've seen some folks try to take that to the next logical step in some regards, and that's to say, well, that's why they're going to eliminate gold too, and they can't let the gold price go up. I think in the grand scheme of things, these banks and the central banks would love to see gold stay down. The banks would love to protect their positions from loss, but if push comes to shove, the far bigger, almost infinitely, exponentially bigger concern of the banks is this imposition of the negative rates and the bail and the fundamental position of negative interest rates. And if they've got to take some losses by cash settling out the futures exchanges, as the gold price rallies, and and see gold go to a couple $1,000s an ounce or whatever, they're not going to care, because in the much bigger picture, the elimination of cash so that they can go to negative interest rates, which is what they're obviously going to have to do and will do, is far more important to them.
The two items are my two arguments to a cashless system, cashless society, are the huge drug money laundering profits that these HSBC, JP Morgan, both have been in a court, both fined for that activity, period. those are cash transactions. That you cannot launder digital blips on a screen. Drug money is not digital blips on a screen. The other part of it is, wouldn't there be almost instantaneously a massive black market, gray market to pop up, and entire communities just say, "Great, that's fine. We're gonna trade. We're gonna and barter, which is already a lot bigger than people think." Wouldn't that just overrun any of that, or do they not care?
Hard to get a feel for the whole scale and size and scope of that, Rory. I don't think there's any doubt about it. I mean, you would get to the point where there'd be a lot of barter, there would be a lot of black market stuff, but from a taxation standpoint, it allows the IRS and everybody else much easier access to the transactions that do take place. There might be a whole lot more that get forced onto their radar. So I don't know. It's hard to say. But as I look at the big picture, there doesn't seem to be any other alternative to the global almost imposition of negative interest rates. And the natural market reaction to that is, well, screw that. I'm taking my cash out of the bank.
Exactly.
So therefore, they will eliminate your opportunity to do that. And then at that point, again, it just augurs very well for the fundamental demand for actual physical gold and silver. And if the banks have to take massive losses, temporarily at least, in the closing of the paper positions, that's fine. I mean, because in the much bigger, far more important picture is their long-term health and maintenance of the system through negative interest rates.
And this question goes out to both of you. Do you think that is part of what's happening right now, in particular in gold, as far as some of the mass or the surge in acquisition of gold?
What's happening in gold and silver right now is a function of two things. Well, really three. I think at the margin, I think there's more individuals who are converting cash into gold and silver. It's still a very small percentage of the overall population. Let's just look at the U.S. Still a very small overall percentage of the population. I still think it's probably less than 1%.
Yeah.
And I think that smart money is starting to accumulate physical gold and silver. And I think they're also running. I'm not saying they're out of large amounts of physical gold and silver that can be delivered into Asia and India and whatnot, but I do think they're starting to run pretty low on it. And I think we're seeing it in India, where India is importing doré bars directly from mine sites in Africa, and that's documented, and that's a business there now. And I also believe, although it's impossible to prove, that I think that the banks on the LBMA are taking I think they've contracted to take delivery of doré bars from the big mining companies, and they send those bars to Swiss refineries, who then refine them into the 1 kilo bars that go into China. And so I do think that, Craig, you alluded to the just-in-time inventory management system that's been implemented, all throughout global economies. I think we're seeing that in the bullion market too.
They certainly appear to be living off a flow, no doubt about it.
Yeah.
And it'll continue. This rally is a paper rally. What has taken place, and everyone's excited about the 20% move in gold. If you want to, picture me making little air quote marks with my fingers, it's been nothing but paper. It's been paper speculators driving into the paper markets to bid up the paper price of gold. And they could easily just be flushed back out, and everybody get all bummed out because gold goes back to 1180 or something like that. And so what nothing has changed, I guess, is what I'm saying so far. Someday something will change, and the confidence scheme will fail. Every uptick increases the pressure on that confidence scheme, which is why they're fighting us so hard, which is why these net positions, these banks, even as reported on those CFTC reports, is so high. They're doing everything they can to protect it and save it. in the end, though, they're just not going to be able to. Once, as you say, Dave, I mean, there's 1% of the population, if that, owns. Well, but I think it was Mike Maloney put out a video, a great video, or maybe it was Grant Williams, one or the other, earlier this year. Just kind of showing everybody the amount, just the size of the global gold and silver market, the mining shares. You could take over the whole thing for a couple of $1 billion. Just buy everything. And so it won't take much. It won't take a lot of global recognition, at least in the West, to bust up this system. It hasn't happened yet, but this price move is increasing the pressure, and that's why we want to see it continue.
Craig, I agree with you that what seems to be driving the move higher is the paper market, but I also do think there's the quote unquote invisible hand of the physical market underneath it, and I do think that the level at which they can manipulate the paper golden market lower is there's a floor underneath it that's been created by the physical market, and I think that floor has been raised quite a bit higher. I mean, if you want to see an interesting chart, just take GDX or the Huey and look at a 2-year daily, and there's been a literal 6-month base formed in the mining shares, and there's a massive increase in volume during that 6 months, and that tells me that it's the smart money that's been piling into these shares. And the thing that's interesting, and again, as you've pointed out, who knows how long this will last, but even on days like today where gold's down $9, the mining stocks are still up over 1%.
No, and it gets back to what we talked about earlier. I think there's all kinds of positive things happening in the paper markets. We just want it to continue, and they're structured now with like we said, the moving averages the way they are to hopefully be supportive. But I guess the overriding thing, though, is nothing much has changed yet. But if price can continue higher, then sentiment will continue to be strong and get stronger. And growing sentiment in the West leads to more physical demand. And it is that physical demand that will ultimately break the system. So we want to see price continue to higher, and that's where the battle's going to be in the months ahead.
Well, we'll have to keep a check in with you there, Craig, and see how this whole thing unfolds, because I think it's going to be a pretty big year, and from everything that we've just discussed, there's a lot to keep an eye on, and I have a lot of confidence in what you're doing, and I really like your work a lot, so we'll have to have you back on.
Well, I appreciate that, Rory. And again, I would encourage everyone. This week will be interesting to watch. Dave, you mentioned the miners. They were up big on Friday, then turned it all the way around and closed negative. They were up big again this morning, and now with gold being down, miners moving down again. So we may kind of trade sideways, up, down a little bit for the next 9 days or 7 days. The key event's going to be that FOMC meeting next Wednesday and the market reaction to it. So everybody just be on your toes, be paying attention, and then hopefully we'll have good news and higher prices into the end of this month, and that will only increase the pressure on the banks and help us all out. So just look alive out there, everybody, and stay alert and situationally aware, and then we'll just see what next week has in store for us.
Yeah, Craig, I just wanted to echo what Rory said. You've been doing great work. Especially the last several months, you've just been on fire, and I would encourage everyone to follow your Twitter feed, because I think that is invaluable for gaining an edge and gaining some insight on what's going on in the markets.
Thanks. I really appreciate it, guys. And again, I'd encourage you. I mean, we do all this at TFMetals Report on a daily basis, and podcasts every day, and reports during the day. And to get all that information, it's a whole $10 a month. So it's not like some big, huge backbreaker.
It's 2 cups of coffee.
Yeah. And like I said, business has never been better. And hopefully anybody listening to us will give that some consideration.
Hopefully so. And we've been speaking with Craig Hemke, who is the president and founder of Turdville, found over at TFMetalsReport.com. And Craig, it's been a pleasure, and certainly appreciate all your time.
Always good to talk, guys. Anytime you want to do it, just let me know.
Thanks, Craig.